let's get started. So it's with great pleasure I'm going to introduce today's keynote speaker, Haskell Garfinkel. Haskell is a partner and the co-founder of PwC's FinTech practice. He brings over 15 years of relevant experience to that role and is really focused on playing at the intersection of financial services companies and technologies and helping technologists learn and to create solutions for financial services and helping financial services companies learn how to innovate and be more technology-centric. Besides traveling around and giving keynotes, he spends most of his time with his colleagues and peers in our FinTech practice focusing on innovating and really helping our clients consume FinTech. There's lots of slideware out there that we've all seen around what could be possible. And we view our role as helping folks kind of get that to market and consume that in appropriate and value-added manners. I've had the pleasure to work with Haskell the last 3 years as we've continued to grow our FinTech practice out here in Atlanta and supporting the FinTech community here. So it brings me great pleasure to introduce Haskell Garfinkel to the stage. Thank you.
All right, thanks, Jim. Let's see if we can get the audio video working here. That's always the first challenge for a technologist. Plugging everything in. So I kind of feel a bit like a substitute teacher up here. You know, I don't know you, you don't know me. We're going to be together in the room here for the next 45 minutes for a full period. So my kids always tell me when they have a substitute teacher, the first thing the substitute teacher does is play a video, right? They find some video to occupy them for about 45 minutes. So I think that's probably what I should do is find a video to play. So why don't we start with some audio-visual effects. I think this video best represents what the world of FinTech is all about, and it'll probably set the stage for the next 45 or so minutes to have a dialogue around the world of FinTech and what it means. So let's take a quick look at this, and then we'll have a conversation.
Should I keep renting? What's an average down payment? How do people like me buy a house? So how do I get started? I can do that. Transfer 200 to savings. Skip the coffee shop.
Love to live here. Ben, how much are homes going for in this area?
And this one, maybe this one. Thank you.
Calculated your total costs, and I'm glad to say it's within your budget.
big word.
So, Ben, what's next?
So why do I show that video when I start a presentation about FinTech? Because as you see from my first slide, and I'm going to get into what is FinTech in a moment, because I think that's a topic. We're all here at a FinTech symposium, but I think there's 500 people in this room, and if we asked every one of these 500 people, we'd probably get 600 different opinions. I like to say, it's about the customer, stupid, right? Quoting Bill Clinton. It really is about the customer. So maybe we'll start with a good definition of what is FinTech. And we'll come back and talk about this video, I think, all throughout our conversation. I think most people, when they talk about FinTech, they like to talk about the startup ecosystem. We at PwC talk about the startup ecosystem, the new market entrants, right? You have a lot of incumbents moving into this space. I don't think of the FinTech world as just about the new market entrants and the startups. We actually think of, at PwC, we think of the FinTech ecosystem as a verb. We don't think of it as a noun. And let me tell you how we think about it. We think about it as 4 moving parts, and we refer to them as the A's, the B's, the C's, and the D's. We call them the A's, the B's, the C's, and the D's because we couldn't come up with anything easier. The A's are the large financial institutions. Large, small, they're the financial institutions. And they're moving in one direction. They're moving towards the B's. Who are the B's? The B's are the big tech companies. Your Apples, your Googles, Amazons, your Alibabas of the world. Interesting anecdote, I just came back from 6 weeks over in Europe, meeting with every major financial institution over in Europe. And the most common question I got when I was in Europe was, we don't want to know what Apple's doing. We don't want to know what Google is doing. We want to know what's going on in China. That was actually the most common question, because actually when you look at the funding of deals that are going on in the FinTech space, the biggest funding, the fastest movers are actually coming out of the tech companies in China. So it's actually the tech companies moving into the FS space. It's the FS companies moving into the tech space, right? Some of the spin-offs you're seeing out of Goldman and others. It's those two converging on each other. And it's what a lot of us are here to talk about today. It's the D's, and the D's are the disruptors, right? It's the D's moving into the space of the tech players and the FS players. It's those folks converging on each other, while at the same time you have what, in our opinion, is the underlying major trend, which doesn't really get the play in the media. It's the disruption not of necessarily the A's, right? Everyone's very fond of talking about what's going on in the disruption of banking. And in a few moments, we'll actually get into some of the hard stats behind some of the surveys that PwC has done recently in this space. It's not necessarily about the disruption of A's in this space. It's perhaps the bigger story of the disruption of the C's. And the C's are what we refer to as the infrastructure players, right? Those are the FISs, the Fiserv, perhaps the Swifts, even the MasterCards, the Visas, the networks, the infrastructure players. You know, if you actually go back and you look at the, I would say, the origin of the word FinTech, the Latin, right, the Latin origin of the word FinTech. You look at the American bankers list of FinTech 100s. Anybody, by show of hands, anybody ever taken a look at the American bankers list of FinTech 100, right? What is that list comprised of? Is it comprised of the Prospers, the lending clubs, the Klarnas? You know, is that what's on that list? No, that's not what's on that list at all, is it? The FinTech players of yesteryear, right, are the infrastructure players, are the technology providers. So there's a little bit of a different definition going on there. And perhaps if you look at and you think of what's going on in the ecosystem, it's not necessarily the direct-to-consumer model that we're all thinking about today in the world that has the most disruptive potential. We'll actually talk a little later on about the unicorns, right? The unicorns who potentially are going direct-to-consumer that is the most disruptive. It's actually these folks out here who has the most potential for disruption. So that's the way we define FinTech, and when I get up on stage and talk about FinTech, I like to throw this out here because I think this is a bit of a better definition. And when you look and you put it at the center of this, where's the scrum, right? Who is everyone fighting over? Everyone's fighting over the consumer. And we look at the video we just put up there, it shows a vastly different world. I think, and I had a conversation earlier this week with the board of one of the second largest insurance company in the UK. And the challenge that everyone in the financial services world really faces is that historically the financial services world was about products, right? They put products at the center of that. The financial services world puts a product out there and they expect consumers to buy it. But when you look at that video, what do you see? You see a consumer-centric world. You see a customer-led world. And that's really what the shifting dynamic that we're really seeing is all about. Let's talk a little bit about why that is. It's because of the megatrends. At PwC, we talk a lot about megatrends. And some facts up here about the megatrends. So we talk about how by 2020, millennials will form 50% of the global workforce. And what is it that millennials are? They're social media natives. They get their recommendations online first. They don't talk to their fathers and their mothers and their brothers and their sisters. They get it from their peers. They want mobile-first solutions. They're not walking into banks, right? They want mobile-first solutions. They want self-directed everything, right? They don't want to be told what to do. It's a very, very different demographic skew than we've seen before. Their investment strategies are different, vastly different. They're postponing retirement. We see by 2020, the baby boomers will be hitting, the baby boomers born between 46 and 64 are hitting retirement age. They're living much longer, advances in healthcare, living much longer, both even in the urban society and even in some of the emerging markets. We're seeing folks living longer. Smaller real estate footprint. So the rapid urbanization, smaller real estate footprint. That's giving rise to the on-demand sharing economy. I got here by Uber today, right? I don't think you can have a conversation about technology today. Every one of them, Uber's brought into the conversation. Ride sharing. My car, I live in urban San Francisco. I own a car. I don't use it. It sits on a service called GetAround. I don't know if folks here have heard of GetAround, but my car gets rented out every day. I make money from my vehicle. Personalized service. I use Amazon Prime, right? I want my groceries, I can have them in an hour. The world is, urbanization, demographic, and social change. And lastly, the shifting economic power. The middle class is some stay as stagnating, but overall the base is actually growing. Maybe in the US it's stagnating, but the base is actually growing. Disposable income globally is actually growing. So these are some of the trends that we're seeing. I guess one of the questions people often ask is why am I qualified to stand up here and talk to you about any of this stuff? Who are my constituents? So by way of background, I guess when I showed you those four circles, what I do for a living is I play all four sides, right? So we work with all four of these players. As Jim mentioned in his intro, when a client, one of my clients, major European bank, decides that 97% of their deposits are acquired via the branch network, and that's unsustainable for them from a capital perspective, and they need to build a digital-only bank where they're going to hold all the current accounts themselves, but every other feature of the bank is going to be built with a FinTech partner. They come to us to build something like that. When a large handset manufacturer decides that their product is unaffordable in a emerging market, and they need some type of equal monthly payment solution for that emerging market, or even here perhaps in the US, when subsidies are moving away and long-term contracts are a thing of the past, they come to our FinTech hub for something like that. When a startup, perhaps in the startup in risk and reg, so anti-money laundering, know your client technology, has a great idea that can help our clients at PwC cut down the complexity and cost associated with compliance. PwC helps a technology like that scale in the marketplace. So these are the constituents that I serve and help these technologies grow and get consumed by both incumbents in financial services and technologies. So that's the perspective I bring as serving all of these areas in the market. So we started talking about the customer. Now the problem is, customers expect, and what I'm about to show you here comes from a report that PwC put out last year called Banking 2020. Customers expect individual accessibility anytime, anywhere, anyhow. Apple iPhone is a good example of that. However, in our surveys, we found that in financial services, only 55% of customers are satisfied with their mobile apps. Pretty big gap. Customers want on-demand products and services, Uber being a good example of that. Yet only 58% of customers in financial services are satisfied with their product offerings. Customers want experience and loyalty-based relationships. Yet, I think this one is the worst, only 45% are satisfied with the loyalty programs in financial services. So this kind of sets the stage for where we're at and why FinTech is ripe for disruption. Furthermore, we learned that 66% of folks don't believe their banks care about their interests at all. This goes back to the product versus customer. 44% don't believe what they see in their ads or websites. And 80% rarely think about which banks they use. Now, this is actually interesting. When I first took over the role, I took a bunch of our millennial staff into a room, and I played a word association game. And maybe we can play it quickly here in the room amongst yourselves. When I asked them about what they think when I say the word financial institutions. So these are PwC staffers between the age of 22 and 28, let's say. I said, when I say financial institutions, you say, let's all do this together. So I say financial institution, you say, louder. I say financial institutions, you say, okay, I heard the word banks, right? When I did it with my staff, do you know what I heard? I said, I say financial institutions, they said apps and websites, okay? So they said apps and websites. They didn't say banks, insurance companies, regulated, Wall Street, any of that. So their only point of reference to financial institutions, they didn't think Moody's and S&P rating and AM Best or anything like that. They thought apps and websites. That's incredible, right? They didn't care. They didn't care. So when customers asked if they could name a bank they could trust, 40% of them said no. So why is FinTech now so accessible? Why are we seeing this massive shift between the incumbents in financial services and this ability for you folks, many of you in the room, I know we have a mix of constituents here in the room, but why is it changing so fast? And I'll tell you, it's pretty simple. My co-founder in the practice, a gentleman by the name of Dean Nikolakakis, who's a deep technologist in the space, has been working in this for over 25 years. He actually worked on one of the original, when Loans.com came out, when B of A set up Loans.com. He actually worked on that. And the cost back in the day of setting that up, he recalls, was north of $20 million to set up the full tech stack. Somebody went back and did a study, and this was an external study we found, of the cost of setting up much of that technology today. And if you look at the graph here, down to 2011, if you take some of that, and this is not the B of A numbers specific, but if you take some of those numbers and pull them down in today's costs, with the cost of cloud computing, you take in cloud computing, open source frameworks, and kind of developers on demand, you're talking about costs that in today's dollars, this was 2011, today's dollars, with AWS and the like, you're talking something that my son can put on my credit card for $500. That's a massive shift. That's a massive shift. So when people ask me often about, is there going to be a burst in the tech bubble? My answer to them is, there may be some dry up in funding, but when my son can set up an app with an API that can be on somebody's iPhone in a matter of days, I'm not overly concerned about the pace of innovation slowing at all. So that's really why we see this unbelievable, and we see 500 people plus here in the room today, and conferences with thousands of folks and billions of dollars growing at a hockey stick-like rate in FinTech. That's really why you're seeing the pace of innovation rapidly growing. So I'm quickly going to go through, in a couple months you'll see PwC put out a global survey of 500 executives around the world on some survey numbers we did around their views, the executives in financial services, their views on the impact of FinTech. Actually, I'm pretty honored today to give you guys a little preview. These numbers haven't been made public anywhere else yet. They're going to be published in the report. A couple things that we're showing you today have not been made public anywhere else. So I'm going to give you a little preview of some of the numbers. And they're pretty impactful. This is which part, and it's kind of hard to see, so I'll talk through a couple of them. Which part of the financial services sector is most likely to be disrupted by the Ds over the next 5 years? The Ds, if you recall, were the disruptors. Banking, obviously, comes in at the top. Executives say that the banking industry, number one, followed by, I know a lot of folks here in the payments industry. So 75% said banking, 55% said fund transfer, followed by investment and wealth management. Those were the top ones. Interestingly enough, investment banking, reinsurance, kind of at the end, kind of at the bottom of the list, kind of 8%. This is the slide that I think is the most impactful, because I'm just curious. By show of hands, can I get who's here from financial institutions? Can I get a show of hands? So maybe 10 or 15% of the room, roughly. What percentage of your business is at risk being lost to Ds within 5 years? So this is a pretty short time horizon. What percentage of your business being lost? Somewhere between 21 and 28%. These are senior executives at financial services institutions who are publicly acknowledging that 21 to 28% of their business is potentially at risk from startups, new market entrants into their business. That's a seismic shift. That's fully a fifth of their business, up to 25% of their business being lost by you guys. Are people reacting fast enough to this? This is not a 20-year horizon, folks. This is 5 years. Look at the top one, the payments industry. And the next couple slides talk about what threats and opportunities folks see in the industry. Pressure on margins, loss of market share, information security risks, and lastly, customer churn. Because we do know one of the issues in FinTech is the ability to capture customers. The hardest thing in traditional financial services is capturing customers. One of the easiest things in FinTechs is customer acquisitions. So some pretty impactful numbers here. And here's the opportunities. Now, I want to point out the one on this slide is cost reduction. So while FinTech may be viewed as a potential, the FinTech startups may be viewed as a potential threat to revenue, I think the flip side of the coin is, and this is constantly what I talk to my clients about, the biggest impact it could have. So the offset to the revenue, however, is the cost savings. Because what we talk to our clients about, and most of the work I do is not in the B2C space. Most of the work I do is actually in the cost saving side of it. And that really is where the biggest potential, in my opinion, really the biggest potential is in cost reduction in the traditional financial services incumbent spaces. And that's why I want to spend just a moment before we get into some of the exciting trends in FinTech, is this slide. Because I think this slide tells a lot about where I think the FinTech players should be focusing their efforts on. So if I could give any advice to you folks, it's at the end of the second half of 2015, there were only 46 FinTech unicorns. A lot of press around the down rounds that we've seen in the FinTech space lately. A lot of folks concerned about whether the bubble is going to be burst. And I think a lot of the press has been focused on this, this investment and what's going on in the market. I think what I want to point out is, right, we have by some measures, 10,000 FinTech startups out there. Only 46 of them are unicorns, primarily focused in the lending and payments space, right? I think the odds are pretty long, right? I'm not sure. I'm not a betting man. I'm a poker player, right? And poker players play statistics and odds. So since I'm a poker player and I don't play blackjack or roulette or any of those games, I would posit that if you're going to go into the fintech space and you're going to invest, don't try to be a unicorn. Don't try to be a unicorn in the B2C space. That's a pretty hard game to win. Be an enabler. Go for where the CEOs in the financial services space are going to accept you. Go in the cost reduction space. Go be an enabler. Go partner with the financial services providers. That's where you're going to be accepted. That's where the opportunities are. That's where right now, if you look at kind of the state of the financial services market where folks are tightening their belt, people are looking for cost savings opportunities. That's really, really where the market's going to be quite welcoming for you folks. So that's where, taking a pause on this slide, I think this is one of the key takeaways. So now I think we're going to get into a little bit about what people, really want to hear about is what's trending in the market right now. So to do that, one of the problems I had when I took over this role is that there's just too much information, right? There's just way too much information in the fintech space. There's thousands of startups. The trends change every moment. The players in the space are constantly moving around, and understanding all of that is impossible. I mean, I run the practice. I have 50 people who work in my group who are constantly monitoring this. It's a Herculean challenge. So what we do at PwC is actually we have a platform. I'll show it to you and we'll walk you through it in real time. Is actually how we monitor the trends. So let's go through some of the trends, the top trends in the industry for a few minutes, and then we'll try to wrap up and take some questions. So let's talk about some of the banking trends. So we'll go into consumer lending, and we'll talk about some of the hot trends in the industry. So marketplace lending. So you can see right now that marketplace lending, so this is kind of what's hot right now. I think folks can see it. So these are the trends over here on the left that are trending. Marketplace lending, enhanced credit underwriting. Marketplace lending is peer-to-peer crowdfunding, connecting unrelated individuals, borrowers, and investors. I think people are pretty familiar with that. This is certainly the top trend we're following at the moment in consumer lending. You've got players in this space like SoFi, Prosper, FinSquare, Common Bond, faster access to capital, and this is also enabling folks to serve traditionally underserved customers. So this fits a lot of sweet spots that are going on right now in the fintech space. Number of fast-moving players in this space. Let's see who's enabling this space right now. There's SoFi, Avant, Prosper, a lot of the traditional names you're seeing in this space. Enhanced credit and underwriting. So these are financial institutions are moving away from traditional FICO platforms to use advanced risk models. One of the hot trends in the area. So these are not necessarily folks who are just peer-to-peer lenders directly. These are also folks who are enabling the ecosystem. Another one that probably doesn't get as much press in the area is in the treasury and cash management space. So the digitization of cash and treasury management functions and other commercial payments ones. So I know we have a speaker later today who's going to be speaking on the commercial payment space. But this is the advent of online cash forms to disrupt traditional cash and treasury management functions. And a lot of SaaS players are moving into this space. So let's take a look at some of the players on this one. So these are not as well-known names. These are folks like Avid Exchange, TradeShift, Tulia, Cribia Corp, Bill.com, you've heard of, Mineral Tree. These are much more B2B players. So you can see some of the top trends that are going on here in cash and treasury management software. Another hot one is in the deposits and bill payment space. So let's navigate over to deposits and bill payment. Integrated platforms for consumer and financial empowerment. So these are more personal financial management platforms. Customers increasingly want to take control of their financial health, empowering individuals with self-service tools and providing them with a sense of authority over their state. So these are integrating financial tools into your consumer banking, right? So these are not just your online bill pay. These are tools like we saw on the video we saw earlier today. These are, I want to save for a particular goal, and I want to center it around my lifestyle. So I want to make that decision not to buy the coffee in the coffee shop. Those are the tools that you would actually integrate into your consumer banking platform. A couple interesting facts in mobile banking. In mobile banking, this was the first year we actually saw over 1 billion people using mobile phones for their banking. People went web first for the first time in 2015 as well. A couple points around the peer-to-peer space that we saw. We saw virtually every major player, Citi, JP Morgan, Wells, all of them ended up this year finally partnering with the peer-to-peer players. So kind of back to the point originally where the peer-to-peer players started out as primarily directly to consumer. What they also realized is the direct-to-consumer model is not going to be sustainable over the long haul. That they also are going to have to white label solutions and go into partnerships. So that's the banking side. Let's go into the investment services side. So this is an area getting a lot of press lately. It's primarily in the retail wealth management space. A lot of folks talking about the robo-advice world. So automation of asset allocation and increased services and solutions for underserved. So these are folks like Betterment, Wealthfront, folks that enable you to do automated asset allocation to disintermediate your traditional, whether it be stockbroker or personal financial manager. Huge activity in this space, and I think this is obviously going to continue to be a trend. One of the issues in this area is how do people make money with it, right? So you're seeing a lot of acquisitions in this space by the traditional providers. Challenge being that service fees are very low in this space. Traditional fees, money management in this space, often in the 1% to 2% range, sometimes up to 3%. Fees in this space are almost down to zero in the quarter of percent range. Another thing you're seeing is the rise of back-end companies like Apex Solutions, back-end companies who are actually enabling companies to plug into this space. So InvestCloud, Apex, Plaid, integration of financial services data to allow robo-advisors to plug in and do the clearing and execution. A very hot trend in the space at the moment. Payments. How many payments folks in the room? You guys want to see payments trends? Or you already know them all? Like I'm preaching to the choir here, right? To do payments trends would kind of be would be self-defeating. But we'll show you some of the hot payments trends in the room right now. So let's go into the issuing space, and let's take a look at what's going on in the issuing world. All right. So here's one of the in the issuing world, emergence of self-service solutions for the underserved customers. So underserved population able to access financial services for the first time through mobile. This is actually a relatively new trend that we've seen pop to the top of our list. Mobile wallets obviously still sitting at the top. A lot of activity across the entire value chain in the mobile wallet space. But my SME wanted me to point out the solutions for the underserved coming to the top. Another trend we're seeing a lot of activity on in the acquiring space is the increase, and let me navigate over to acquiring. The increase in bundling of value-added services around customer insights and the rise of adoption of next-generation POS solutions. And a lot of clients coming into this through the big data analytics. So to checkout, Zoos, Kopo, ARM Insight, Punchy, a lot of activity going on here, a lot of movement in this space, a lot of money coming into this space. So we actually cover this by 46 different industries. A lot of activity this year in the past 15 months in the payment space as evidence, and I'm actually going to go back into the Georgia piece now to talk about what's going on in Georgia, because clearly payments activity in Georgia is hot. I want to talk for a moment about Georgia and the culture of innovation here. When we were writing this, last night, we were talking about what the tagline should be for Georgia here, and I learned. I'm actually from the South. Lived in Georgia for quite a while. My daughter was born here, and I said, you know, how many Peachtree streets are there in Georgia? I should give a prize for this. Anyone know how many Peachtree streets? The name of Peachtree? How many? 71 streets have the name Peachtree in it in some way or other, according to Wikipedia. 71. 71. I work with a lot of, I travel the world and talk to a lot of not only organizations, but a lot of municipalities. So whether it's London or Zurich or Singapore, about what it takes to foster a culture of innovation, both in the city and at an organizational level. And I've worked with Jim in Atlanta, the Atlanta FinTech team here for quite some time. And Georgia has all the right ingredients. Atlanta has all the right ingredients. And that's why, and we'll get into some of the numbers in a moment, but that's why you guys are doing it right out here. It requires a public-private partnership, first and foremost. That means the right private companies, cluster of private companies who are focused on innovation. You clearly have that. It requires an excellent university system focused on innovation. So I actually now live out in the Bay Area. I live in San Francisco. And when you look at the mirrors between San Francisco and the Bay Area, there's a lot, right? You have excellent universities. You have top-notch corporate campuses who are focused on developing. You have organizations like this who are bringing the two together and fostering that culture. You have private capital flowing into it. You have all the right ingredients. And I'm not going to point out the cities that aren't doing it right, but there's some cities that have tried to do this, and the problem is they can't bring it all together. Looking at the room today, it's pretty clear that you folks have brought these ingredients together, and it takes a concerted effort. This doesn't happen by accident. That's the other thing, and it's the same ingredient that requires the success inside for-profit organizations that requires to do it at a macro level. And it's that concerted effort and sustained effort. So you can't just say, oh, I wish we would have this. It has to happen by folks dedicating time and effort. And I clearly can see that TAG is really doing that. We took a look into our de novo platform. This is some information we saw, that was provided to us. 100 companies or so. But this is some unbelievable information. FinTech is actually the leading. I guess FinTech is the leading the funding in the Georgia area over other, including healthcare, which is pretty interesting. Mobile and telco, considering some of the other companies in the area, and payments, obviously, rich history in payments. But when we looked at some of the trends that you guys were tied to in our platform, mobile wallets, obviously big, alternative credit underwriting, faster payments initiative, not surprisingly, and simplification of the online checkout and payment experience. Self-service solutions, and obviously the rise of marketplace lending. A lot of your incumbents very active in acquisitions of FinTech players. First Data, Global Payments, TSYS, and WorldPay, a lot of major acquisitions in the space. So you got a lot of capital flowing in and into and out of the ecosystem, which obviously is key. London, Silicon Valley, these are also the ingredients that they have for their success. So clearly you guys are one of the top players in the ecosystem as well. So we're running a little bit short on time, but I think those are the key trends overview in the kind of what's going on in the industry that I thought we should cover here today. I want to thank you guys for your time. We have about 3 or 4 minutes left for questions, if there are any. So I'll pause here and take some questions. I don't know if there's anybody out there in the audience with a mic. It's an excellent question. I would say one of the critical things is partnering with universities, right? Critical things is just continuing to partner with universities. Boston is a good example. The partnerships that we see with MIT, the partnerships that we see in the Bay Area with Stanford, those things are critical. That is the I would say the crux. But as much as things happen in the labs at companies like Google and Apple's obviously a unique creature, but companies like Google and Apple and Amazon and those companies, that things happen in the lab, they happen even earlier in the academic research, right? So it's the academic research that is the seed, and partnering with the academic research is one of the keys to success. So I would say that continuing to foster working with the academics, very important.
Thank you.
Other questions? I know it's a shy group over here. Over here?
Got a mic for him. Whoever gets there first. Well, this is going to be a softball for Sean here, actually. So how important is venture capital in that mix that you're talking about? Because I have a suspicion that there's a lot of innovation that's coming from areas with a lot of funding and universities and public support for the environment that ties it all together.
It's the lifeblood. It's the lifeblood. Venture capital is what makes this world go round, right? The problem, being transparent, the problem is that R&D spend of the traditional incumbent players is so tied to quarterly earnings that it's not possible to get the R&D you need out of the traditional players, right? So what you see now, and it's not just within FinTech, it's across the entire innovation ecosystem, is that basically you've kind of you've off-balance sheeted your innovation, and that innovation now is being funded, perhaps outside of pharma. That innovation is now being funded by the venture capitalists and to a certain extent the PE players and the angel investors, right? That's where innovation is being funded right now. So, depending on what happens with the economy, we need to make sure that market still stay pretty vibrant. Other questions? Sure. Can't see you with the lights there. I'll move over here. I have a lot of them. I actually am responsible for the blockchain practice at PwC, so I have a lot of them. As far as currencies or technologies, so blockchain, clearly I spend about 40% of my time on blockchain technologies. Bitcoin is the most stable and mature of the protocols on the blockchain. So it's been around the longest. It has not ever been hacked. We've clearly seen, people left the gates open when it came to things like Mt. Gox. That wasn't a hack of the underlying protocol. That was where somebody just literally left the bank vaults open and people walked in and took all the money out and walked out. But the underlying protocol has never itself been hacked. I think the protocol, the blockchain technology, clearly, and PwC is heavily involved in it. You may have seen some media releases about our partnerships recently in the space with some of the key players in the space. The technology itself, will be heavily applicable to all areas, all the key areas of financial services, because of the simplicity in which the ecosystem of trust works, and the low cost associated with using it. Bitcoin itself, as a currency, I think that itself may have passed already as a currency, but it was a proof of concept for how that will work, and I think it was an excellent proof of concept. Other questions? All right. Well, we've just run out of time. Thank you, everyone, for your time. I appreciate you sitting with your substitute teacher for the past 45 minutes. Thank you. Okay.